Crypto lending is a modern and reliable way to get money right now using your cryptocurrency as collateral. In this video, I'll explain what crypto lending is, how it works, and highlight the key things you need to know. Let's get started. Crypto lending means taking out a loan secured by your cryptocurrency. You deposit your crypto as collateral and receive a loan in digital dollars, like USDT, USDC, or another supported currency. This works differently from taking a loan at a traditional bank. The key point is that most cryptocurrencies are highly volatile. Their prices can rise or fall very quickly. To protect themselves and their clients, lenders on crypto platforms require collateral that is always worth more than the loan you receive. Both banks and crypto platforms give loans against collateral. In banks, it's usually a house or a car, while in crypto, it's digital assets. But the mechanics differ. At a bank, you must repay the fixed loan plus interest, even if your collateral loses value or its sale doesn't cover the debt. That means you can lose your property and still owe money. In crypto lending, the loan amount is directly tied to the market price of your collateral. If your crypto drops in value, the lender can sell it to avoid losses. You might lose your assets, but you won't owe anything extra. In short, your obligations are limited only to the collateral you've deposited. The main difference is this: a bank loan can leave you with debt even after losing your property, while a crypto loan is always limited by the value of your pledged assets. In this video, you'll learn the main concepts and metrics of crypto lending. We'll go through the process, share examples, and explain everything in simple, clear way. Stay tuned. To take a crypto loan, you must provide collateral in another cryptocurrency. This guarantees stability and safety for both you and the lender. As collateral, you can use any cryptocurrency you own, such as Bitcoin, Ethereum, XRP, POL, and others. The value of your collateral must always be higher than the loan amount you receive. LTV, or loan-to-value, is the ratio of the loan amount to the value of the collateral multiplied by 100%. It is one of the key metrics in crypto lending. It defines the level of safety of the loan, and its change can lead to different events, such as receiving a margin call, a warning, or liquidation of the collateral, its sale. Let's look at how LTV is calculated. Suppose you have $10,000 in some cryptocurrency that you are ready to provide as collateral for a loan. You want to borrow $4,000 in digital dollars, USDT, which equals $4,000 in regular dollars. Divide $4,000 by $10,000 and multiply by 100%. We get 40%. This is your LTV. When talking about LTV, it is important to distinguish between the initial LTV before taking a loan and the current LTV. Before you take out a loan, on any platform that provides crypto lending services, you will see the initial LTV. This is the ratio of the loan amount to the collateral value, which is one of the conditions of your loan. You can borrow at the maximum initial LTV offered by the platform, or you can adjust the LTV to the level you need. After taking the loan, your LTV will change depending on market fluctuations and the changing value of your collateral. Platforms that provide crypto loans monitor changes in LTV and take certain actions when LTV reaches a particular level. After taking the loan, your LTV becomes the safety metric of your loan. You will then need to pay attention to the current LTV, the margin call LTV, and the liquidation LTV. Current LTV, the ratio of the loan amount to the collateral value at the present moment. To check it, simply open the details of your loan and look at the current LTV. You can also calculate it yourself by dividing the loan amount by the current value of your collateral. Margin call LTV. This is the ratio of the loan amount to the collateral value at which your collateral has fallen to dangerous levels. In other words, your collateral has significantly depreciated and entered the so-called danger zone or liquidation threshold. This can also happen if you do not repay your loan for a long time and a lot of interest accumulates. The exact value is determined by each platform, but usually the margin call level starts at about 80%. If your LTV rises to this point, you will receive a margin call, a warning. You will be asked to increase your collateral or repay part of the loan to reduce LTV. Liquidation LTV. This is the ratio of the loan amount to the collateral value at which the platform sells your collateral to avoid losses. If after receiving a warning, you do not take any action, do not increase the collateral or repay part of the loan, the platform may sell your collateral. Try not to allow this situation, and then you will not face any problems. Liquidation LTV values usually start at about 90%. Now, let's look at an example of how your LTV may change depending on the market situation and what events may occur. Suppose you borrowed digital dollars secured by some cryptocurrency when its market price was at its highest. At that moment, the ratio of your collateral to the loan amount, that is, your current LTV, was 75%. Your loan was in the green safe zone. However, the price of the cryptocurrency you pledged began to fall sharply. After some time, your LTV reached 85% and you entered the yellow zone. You will receive a margin call, a warning about this. You will be asked to increase your collateral or repay part of the debt. If you do this, your LTV will stabilize and you will return to the green zone. If not, then with a further drop in the price of your cryptocurrency and the growth of LTV, you may enter the red zone when your LTV exceeds the threshold value. In this case, you will face forced liquidation. The platform will be forced to sell your collateral in order to avoid losses. Keep an eye on your LTV and follow the requests of the platform where you take the loan, and in that case, you will not face liquidation. In crypto lending, interest rates are like a fee for using borrowed funds. If you borrow digital dollars against your cryptocurrency, you are required to pay a certain percentage every year, month, or day for as long as you keep the loan. It all depends on the terms. This is a key element of the lending system that motivates lenders to provide loans and borrowers to manage their risks responsibly. It is also important to note that interest often does not start accruing immediately after taking out a loan, but only after some time. Rates can be either fixed or flexible. Fixed interest rates are set at the moment the loan is issued and do not change until it is repaid. This is convenient for long-term borrowers who want to know exactly how much they will pay in the end. However, such rates are often higher, since the platform takes into account possible market fluctuations. Flexible rates depend on supply and demand for loans. For example, if the platform has many free assets and few people willing to borrow, the rate will be low. But as soon as demand for borrowed funds increases sharply, the rate can rise several times. This option is suitable for those who borrow for a short time and are ready to monitor the conditions. There are several factors that affect interest rates in crypto lending. Firstly, the type of crypto you use. If you use stablecoins as collateral, the rates are usually lower. But if you use altcoins, the rates are higher because they're more volatile and risky. Secondly, loan-to-value, or LTV. A higher LTV means you're taking more risk. And with more risk, the platform charges higher interest. Thirdly, the loan term. Short-term loans are usually cheaper. But if you borrow for a long period, the cost goes up. And finally, the type of platform on CeFi platforms. Rates are usually fixed and predictable. On DeFi platforms, rates are market-based. They change depending on supply and demand. It is also worth mentioning crypto loans with a zero interest rate. These are loans secured by cryptocurrency, where you do not pay interest. You only need to return exactly what you borrowed, with no extra charges. The platform earns not from interest, but in another way. Usually, a one-time fee is charged when the loan is issued. That means to take such a loan, you only need to pay a one-time commission. The main advantage of such a loan is the absence of interest accrual over time. But the risk still remains, just like with regular loans with an interest rate. If the value of your collateral drops significantly and the LTV exceeds the liquidation threshold, your pledged cryptocurrency will be sold. There are many ways to earn with crypto lending. Here are the most common ones. Firstly, you can get money without selling your coins. For example, you pledge your cryptocurrency and receive a loan in stablecoins, like digital dollars. This way, you keep your coins and wait for them to grow in value, while still getting money you can spend. Secondly, you can borrow at a low rate and invest at a higher rate. For example, you borrow $1,000 at 5% and invest it in a service that pays 10%. After 1 year, you pay 5% to the lender and keep the remaining 5% as profit. Thirdly, you can use leverage to increase your potential gains. For example, if you already have crypto worth $2,000, you borrow another $1,000 and buy more coins. If the price rises, you make even more. But remember, if the price falls, you risk losing your collateral. Fourth, you can invest borrowed funds into yield pools. For example, you take $1,000 in stablecoins and deposit them into a pool that gives 8% return. If your loan costs only 4%, you end up with 4% net profit. And finally, you can use a crypto loan to grow your business without selling your crypto. For example, you have $10,000 in cryptocurrency, and instead of selling it, you take a $4,000 loan in stablecoins. You can use this money to start a project, buy equipment, pay for marketing, or cover other business expenses. Your crypto stays in your wallet and can still grow in value. If it increases to $15,000, you keep the profit while also using the loan to cover your costs. This way, a crypto loan lets you fund your business and pay for expenses while keeping the benefits of your crypto investments. Please note, your collateral is always bigger than the loan you take. If the price of your coin drops too much, the platform can sell your collateral. That's why it's important to always leave a safety buffer and keep an eye on the market. Crypto lending has many advantages compared to traditional bank loans. They are incredibly convenient and simple to use. With flexible terms to choose from, you can set up a loan that perfectly matches your needs. Crypto lending is profitable. You can actually earn on it, and it's safe. You have full control over the process and can monitor your loan at any time. By personalizing the loan conditions, you can also avoid additional risks. Let's explore all the benefits in more detail. Firstly, accessibility without banks. In traditional finance, to get a loan, you need a bank account, official income, credit history, and lots of checks. In crypto lending, all you need is the internet and a crypto wallet. For example, someone in a country with limited banking, like Venezuela or Nigeria, can use their crypto as collateral and get liquidity in stablecoins without ever going to a bank. Secondly, flexibility of collateral. Different platforms accept different assets. BTC, XRP, stablecoins like USDT, USDC, or DAI. For example, if you only have one type of crypto but want digital dollars, you don't need to sell. You can pledge it as collateral and receive stablecoins. Thirdly, you keep ownership of your assets. When you sell your crypto, you lock in profit or loss and lose future growth. With collateral, you keep your coins. If they rise in value after repaying the loan, you get them back with extra profit. For example, you pledge one crypto worth $1,800 and borrow $800. 6 months later, if that crypto is worth $2,500, you repay the loan and reclaim the coin, keeping all the growth. Fourthly, no credit checks. Banks judge you by your credit history, income, and more. In crypto lending, the only thing that matters is your collateral. For example, Even with no official income and no credit history, if you hold crypto, you can still get a loan. Fifthly, global access. It doesn't matter if you're in the US, Europe, Asia, or Africa. Crypto loans are GLOBNO residency or citizenship checks. For example, a freelancer in India can borrow digital dollars to pay rent in another country without converting rupees or opening a local bank account. Sixthly, fast approval. With bank loans, approval can take days or even weeks, especially for larger amounts. But with crypto loans, the approval process is much faster. Decentralized platforms rely on algorithms, and centralized services have automated checks. As a result, approval usually takes just minutes. For example, if you already have collateral in your wallet, your loan can be approved almost instantly. In Cropty Wallet, for instance, the approval takes about 1 minute. Seventhly, potential tax benefits. In many countries, selling crypto is a taxable event, but using it as collateral is not, so often there's no tax. Plus, the interest you pay can sometimes be counted as an expense, lowering your taxable income. For example, in the US and parts of the EU, pledging crypto is not taxed, and interest payments may reduce the final tax burden. Eighthly, lower rates in many cases. In some countries, bank loans cost 15–30% per year. In crypto lending, especially with stablecoins, rates can be 5 to 10%. For example, in Argentina, bank loans may reach 50–70% annually, while a crypto loan in stablecoins could cost just 8 to 10%. Ninthly, transparency. On decentralized platforms, all rules of collateral, liquidation, and interest are written into the code and can't be changed manually. Centralized services set rules as a company, but they are still public. For example, you always see in advance the LTV of your asset, the margin call threshold, and the interest rate. In Cropty Wallet, all conditions are displayed clearly, and thanks to a simple interface, even first-time users can understand the process quickly. And finally, flexibility in risk management. You decide your own level of risk. A low LTV, like 30 to 40%, means safety, low rates, and minimal liquidation risk. A high LTV, 70–80%, means more funds available, but with higher risk. For example, with $10,000 in crypto, you can borrow $3,000 at 30% LTV with little worry, or $7,000 at 70% LTV. But then a 20–30% drop in price could put you in danger. Crypto lending is simple. Let's see how it works, step by step. First, you choose the asset you want to use as collateral, for example, Bitcoin, XRP, or another coin, and set the amount. The platform checks the current market price of your collateral and offers a loan limit. Next, you select the loan amount and the terms. On the screen, you immediately see key metrics: LTV, liquidation threshold, interest rate, and fees. You also choose whether the terms will be fixed or flexible. After that, the money is credited to your balance very quickly. You can hold it, spend it, or transfer it. When you repay the loan, either in parts or in full, your collateral is returned to you. There are two ways to take a crypto loan: through a centralized platform or a decentralized one. CeFi platforms are centralized services, similar to online banks, but in the crypto world. The company manages your assets and takes care of security. Everything is simple. You download the app, register, and deposit your crypto as collateral. If needed, you can contact customer support or even recover access by email or phone. Loan conditions are usually fixed and clear. The downside is that you trust the company with your crypto and rely on its reliability. DeFi are decentralized services, where everything works through smart contracts without intermediaries. At first glance, it looks like you are in full control. You connect your wallet, start the loan process yourself, and all conditions are written in the code. But in reality, this control is an illusion. Even if you are a programmer, you cannot fully verify or understand how the smart contract works. You completely trust anonymous developers who wrote the code, but take no responsibility for what happens with your funds. There is also no support. If something goes wrong, you are on your own. People often say that DeFi is transparent and everything runs on smart contracts. But in reality, we see something very different. Protocols are hacked again and again. Here you can see examples of major DeFi platform hacks that occurred over the past 2 years. In fact, there are many more cases, and according to our data, DeFi service hacks happen frequently. All of this further confirms that DeFi is not as straightforward as it may seem. Crypto lending is not about living in endless debt. It's about managing your assets wisely. Instead of selling them at the wrong time, you can keep your crypto and still get money for important goals: business, education, investments, or simply peace of mind in a fast-changing world. Cryptocurrencies are no longer just long-term assets. Today, they can also be your tool for flexibility, giving you access to benefits right here and now, without ruining your plans for the future. See you in the next videos.